It has become much easier to invest directly with many top dividend-paying stocks and potentially save yourself a pretty penny in the process. More than 1,000 dividend-paying companies offer direct purchase plans of stock, which is usually an offshoot of the company's Dividend Reinvestment Plan, or DRIP. As Charles Carlson says in his book, The Little Book of Big Dividends, direct purchase plans allow any investor, young or old, rich or not so rich, to buy quality stocks in amounts that make sense for their situation. The three main advantages of buying direct are that investment minimums are quite low, usually less than $250, and can often be below $100. This makes it affordable for most investors, especially when starting out. Both full and partial shares can be purchased, with dividends paid out on both the fractional and full shares. The fees are very modest. In most cases, you'll pay less than $5 per transaction, and many plans have zero trading fees. So how do you purchase via a direct purchase plan? Here are 5 simple steps to follow. First, contact the company. Either call the company's toll-free number to obtain the plan brochure and enrollment form, or obtain this information online from the company or its transfer agent. A transfer agent is a company that is hired to administer the direct purchase plans. Number 2, read the plan brochure. To ensure that you don't have any surprises, read the plan brochure carefully. Check out what you can and cannot do upon enrollment. What are the initial minimums? Are you able to use the direct purchase plan for a Roth IRA, which is what I highly recommend using? Also verify if there are any associated fees that may be charged on the buy side. Third, make your initial investment. Either send in the completed application form with your check to the company or its agent, or complete the process online at the company or transfer agent's website. With online banking becoming more and more the norm, this is a popular, simple option for many investors. Number 4, keep accurate records of your investment. Once you have made your initial investment, you'll receive a statement from either the company or the transfer agent. This statement will show the amount and cost of the shares you have acquired. In most cases, you will not receive an actual stock certificate unless you make that request in advance. Your best bet is to set up a folder or binder with all of your stock investment transactions so that you can keep track of what you have. Having everything handy also makes it easier to compute your cost basis for tax purposes should you sell your shares down the road. And number 5, rinse and repeat. Once you have made your initial investment, you can choose to have your dividend payments automatically reinvested when they come due, and you can also make optional future contributions. Since the minimums of most plans are quite low as $50, you can begin building a sizable portfolio over time with minimal cost to you. I would be remiss not to mention that the 3 biggest disadvantages of direct deposit plans are: number 1, you can't control the exact buy price. Number 2, you're required to keep track of your holdings. And number 3, some plans do involve fees. Despite these undesirable qualities, the benefits of investing directly with the company are well worth it down the road. Carlson stresses that every dollar you pay to buy stock is one less dollar in cash flow generated by your investment. Buying direct makes sense for many aspiring investors wanting to put the maximum amount of capital to work for them in generating wealth. To learn more about how you can invest in the stock market, visit us at Stock Investing Simplified. To your ongoing success as an investor,